recording. All right, we'll have that available for us later. If you have any questions, feel free to chime in at any time. Also, please, if you have the capability, mute your phones. Mute them on your end. That way I won't have to mute everyone. And then when you have a question, you can just unmute your phone and ask it at any time. So we appreciate that. This morning we got Gary Griffin and Ray Chiamurla. Is that how you say it, Ray? They're going to touch on the...
it's Camulera.
Camulera. Whoa, I butchered that one, didn't I?
I have more comments.
Camulera, they're going to touch on some 7A loan underwriting. Talk a little bit about Gary. Gary is a 35 veteran of SBA lending, 35 years.
So I've got Margie and you.
He's a CPA and president of Capital Growth Solutions, SBA loan provider in Chattanooga, Tennessee. And Ray is a 25-year veteran of SBA lending and president of Radar Lending Services, SBA service provider in Indianapolis, Indiana. And we appreciate them. They both are current presenters at SBA conferences and throughout the year and all over the country. So further ado, we'll turn that over to them. Appreciate it.
Okay. Well, thank you very much. Ray and I have known each other for years. We met at an SBA conference we were doing presentations for in Alabama some time ago. The information that Richard and Leo have asked us to go over is typically something we could actually do in a 2-day period of time. So we're going to go relatively quickly over this information. At the end of the presentation, you'll see Richard, Leo's, mine, and Ray's email addresses. Please feel free to call or email us at any time with any questions. Ray and I do this all the time, and we do a lot of pro bono work for SBA. So feel free to ask any questions. We travel a great deal to visit our lenders. So again, you're not bothering us by asking questions. Per Richard's email that he sent out earlier, we're going to try to go over the SBA application, the processes and practices that we do, what really needs to be in the SBA credit memo and the format that we use, touching on some financial statement analysis, which is really going to be what is one of the keys to SBA lending really is working capital, and Ray is one of the masters at putting together formulas for calculating working capital and global cash flows. So he's going to handle that section of it. And then we're going to talk about some of the problems and challenges we have dealing with the SBA. Go ahead, Richard. Okay, what we are going to do, again, is basic reviews of the submission process and best practices that Ray and I have defined over the years. What this seminar will not do is it's not going to go over every scenario. We're not going to review the SOP. We've got to assume something that you guys are at least familiar with the SOP. If you're not, it is not a horrendous read. It'll take you 2 or 3 hours to sit down and read the SOP cover to cover. You may not get it all, but it will give you a working handle on what you're doing. And this is not geared towards PLP lenders. PLP lenders are held to a higher degree of scrutiny. Certainly you can use the techniques that we're going to be talking about here, but PLP lenders really, really need to be careful and need to go the extra step in underwriting their credit, since SBA is not proofing the credit memo. Going on. The application process itself, there is, if anybody has been under a rock and doesn't know, there's a new process coming out called SBA 1, which is a TurboTax-like model that's going to be a menu-driven or a decision tree, I believe is what the technology term is, driven application process that should make just about anybody able to fill out an SBA loan application. I have seen the demonstration of the product, and I'm not actually sold on it yet, but we'll see what happens once it actually rolls out in January. It's going to roll out in a kind of beta test in January. Then more and more lenders are going to come on board, so that everybody should be using this by June. But that's still to be determined in my book. Make yourselves familiar with the SBA website. SBA spent a lot of time and effort and a lot of intellectual capital in developing their website. It answers a ton of questions, and it is very easy to navigate. Go to the For Lenders section. in the upper right-hand corner of the website, and just play with it when you've got some spare time. It'll give you a lot of information and is really very self-explanatory. For the application itself, right now there's probably a half a dozen software vendors out there. PCFS, SBA One, which is now part of Encino, TSoft. There's a 504 company credit application, and there's one other I can't think of off the top of my head. We don't use one of these vendor processes right now because it's easier for us just to go to the SBA website and follow the format, and we'll go over that a little bit later. But there is absolutely nothing wrong with any of those vendors, and if that makes you comfortable in terms of generating a credit memo, because all of them do generate very fine credit memos, please feel free to use them. Also, Ray and I are part of a new industry. It really wasn't new when it was brand new when he and I got into it. Back in 2008 when I started this company, there was maybe 2 LSPs out there. There's now well over 40 on the NAGLE website. We are complete back rooms of small community banks that do not want to or invest in the personnel to establish a complete SBA department. Where both of us are nationwide, and there's a number of other LSPs out there that are fine people. I would just check with the SBA district office or with other people in the industry, because there's a lot of LSPs out there that do not know what they're doing. So just check with your district office and other lenders in the marketplace before you hire an LSP. The SBA district offices have lender representatives now who are like Richard and Leo, and there's 2 or 3 in every state. These people are very knowledgeable. They would be happy to help you if you have any problems, and they will provide free training for your institution anytime that you ask them. And finally, NAGLE is the National Association of Government Guaranteed Lenders. I have been on the board of NAGLE a couple of times over the last 35 years or so. It's a great organization. It is very user-friendly. They send out a monthly newsletter with all the changes. It's a resource source. It's a job posting site. It does just about everything SBA, and it's a lobbying group with Congress to make sure SBA gets funded. So if you're not a member of NAGLE and you're going to do more than 2 or 3 loans a year, I would recommend you become a member of NAGLE. The application process is really so simple nowadays. And Ray, please jump in here if you disagree with anything that I'm saying. The Forms 1919 and 1920 are the SBA loan application. Back in the 70s and 80s, we used to be talking 6 inches to 8 inches worth of paper every time you did a loan application. That is pretty much gone by the wayside. There are 2 applications now, the 1919 and 1920. I'm not going to go over them because they are so simple and so self-explanatory. Something to pay attention to is the Form 912. That can bite you in the butt if you do not do it. It is not a required form any longer unless you have customers that have had a felony conviction at some point in their lifetimes. And we find right now somewhere around 10 to 15% of our applications have had somebody with a DUI, a brawl in college, a bar fight, and occasionally we'll find something like mail fraud and bank fraud. So you need to ask that question when you're talking to your customers right up front. It is not that big of a deal if it's something minor like a DUI 10 years ago. You have the form filled out, you send it off to your district office, and they typically will clear it right then and there. If it's more complicated, it goes to D.C. for an FBI background check. That takes 30 to 45 days. But if you start the process, ask that question right when you start the process, it'll probably be ready by the time you're ready to submit your application. There's a debt schedule that's very informative. You'll see some links that we'll give you here in a few minutes. When you're submitting an application to Sacramento for processing, you have to have all the information on your notes. We go the extra step and actually send copies of the notes. But fill out that debt schedule or you will have a screen out from SBA asking for additional information. The credit memo itself we will go over in terms of what I think the highlights are. And again, Ray and I, everybody's got their own preferences on how they do a credit memo based on the learning tree. If you've been in this industry long enough, you've probably worked for all the major lenders. at least Ray and I have over the past few years, being the last 30 years or so. So everybody's credit memo is a little different, but the facts that go into the credit memo are always going to be the same. Business valuations, if you've got any change of ownership, get your business valuation done right up front. That is something that has never changed. You have got to get your business valuation done, and I would recommend when you have a customer getting a business, buying a business, that they shoot you a copy of the purchase agreement before they execute it, because you want to make sure, one, that the purchase price is going to be verified by a business valuation, because SBA will not finance more of a purchase price than the business valuation supports. And two, there's little things in there like the existing management cannot stay on board. IRS verifications, the famous 4506T, get that signed as soon as you start your application process. One, it will weed out anybody that may be thinking about funny business, and I would say probably 20% of the time when I get a 4506T back, it is different than what we originally were received from the customer. And it's not always, or it's very seldom, somebody intentionally trying to mislead us. But it's things like if somebody has filed an amended return, the IRS will not post an amended return to their website, so the information you get may be different from theirs. There may be transcription errors. Everything is scanned in. It could be a mistake. You just need to document the file and have your verification done before you submit to SBA. And then CAVERS is the avenue you have to go into as an individual institution to verify that the individuals, the principals, and the business have never defaulted on any government loans. That will preclude your borrower and or principals from SBA financing. Moving on. Best practices. This is, the best $300 you ever spend is get the full Adobe package. I write a lot of loan policy, so what I can do with that is I can scan in a bank's loan policy and convert it to Word by the press of a button. That's what its best use of for me, so I can go in and cut and paste where I need to make sure a bank's loan policy complies with SBA policies and procedures. But the reason my submission people love it so much is you can organize scanned documents into complete files, just like it would be a paper file. And where you can do this is you can do things like, quote-unquote, the SBA way. You can follow their 10-tab submission process, get all your information put in the right place. If you send in a bunch of papers that is not well organized and labeled, a technician will get your stuff, and this is, somebody barely above minimum wage over in Sacramento that's going to be putting these things together, and they're not going to understand exactly what you have sent them. So they're going to either throw stuff away that they don't think is important, or it's going to be put someplace where the loan processor themselves cannot find it. Save yourself screen out letters, and this one thing right here will eliminate 75% of your screen out letters from SBA. It'll take you an extra 20 minutes to a half an hour to create it, but it will save you weeks in the submission process. The must-dos in the credit memo, always break down your working capital. This is something that is weak in what I see in most credit memos that are we receive from the banks. They say we're giving them $200,000 in working capital. Okay, that's great. Why are you giving them $200,000 in working capital? That will SBA will screen that out almost automatically. And as again, we were talking about the credit memo, list the debts, make sure at least term the original purpose, because that's going to determine the eligibility. In other words, if somebody cashed out of a deal, the amount that they cashed out is not going to be eligible for SBA financing. If they did something with personal with the proceeds, if they bought a partial interest in a business, things like that are not going to qualify for SBA financing. So if you know the original purpose, make sure you outline that in your note. Secured by, meaning that you're going to have SBA policy is that you're going to take the same collateral when you're refinancing an existing note. Your current payment is going to be important because you're going to go into your proposed new payment in the savings. If the equity injection is required, verify the funds before you make the application and make a statement that you have verified those funds in the credit memo itself. And again, clearly state the interest rate that you're going to be charging, any adjustment periods and payments. And the reason I say this, and I'll say this 3 or 4 times during this presentation, is loans morph from the time they come in the door to the time they've finally been approved at credit committee, especially if they're larger credits. You might have proposed something at prime plus 1.5%, 25 years, adjusted quarterly or as low as Wall Street Journal prime when you started the process. And when it gets out of loan committee, it might be 15 years, prime plus 2, fixed for 5 years, and then floating. You just make sure that you're consistent in your forms 1919, 1920, in your credit memo. Moving on. Must-dos. Must include a statement in your credit memo saying that prior to submission, a 4506T was sent in on the business. The transcripts were received, and you have to state that they were verified for the years that you verified them. In this particular case, 11, 12, and 13. If you do not, you will receive a screen-out letter. You do not want these screen-out letters, by the way, because that means the SBA processor has put it aside on his desk and went working on another file. You want all these questions answered so as they go through their checklist in Sacramento that they're going to be able to check yes to all these questions and get to the meat of your credit. Recently, SBA asked us to state that, again, that's just something that's happened recently. I'm sorry, Richard, go ahead. Always, again, this is my practices, and Ray, you may do something differently. I always state what SOP I'm using when I'm doing a credit. Just in the past 24 months, there have been 4 different versions of the SOP. And there's minor changes and glitches. I shouldn't say glitches, minor changes in terms of things like insurance, verification of equity, that sort of thing, business valuations, 4506Ts, those sort of things. But if somebody's going to pick up your file and second guess you at some point in the future, it's always wise to say which SOP you used when you underwrote the credit. And again, that doesn't affect you guys if you've done a great job on the front end, but I don't care how good of a job you do, probably 1 in 20 loans is going to go into default for reasons that you have no inkling about right now. So again, you're just covering yourself in the event of a liquidation. Okay, we're going the wrong way. Okay, the 1919. This is again the common mistake is that just about everybody and their brother has to sign the 1919. It's got to be signed by everybody owning 20% or more ownership. Any officer and director, if they, no matter how much ownership they have, if they're listed as an officer or director, they have to fill out the 1919. Any key employees and any and all guarantors. The exception to that is when a spouse is pledging a spousal interest in a residence, and of course that excludes Texas where you cannot take a second on a residence or even, anyways, it does not include a spousal guarantee. Moving on.
Gary?
Yeah.
I need to go back a little bit. Something happened with the presentation. I think I missed about 3 slides. So
okay.
I don't think we touched on this one. This is where we left off. Okay, right there.
Okay.
Okay, sorry about that.
Okay, there's collateral. That's also obviously a hot button with SBA. 3 things. 1, you state that all available collateral has been taken. This is on loans that are $350,000 and above, the formal SLA loan, which is now called a small loan. And then if the loan has not been, if you have not taken all collateral, you have to make the statement the loan is fully secured by the above collateral, meaning that you've used the SBA's percentages, and based on those percentages or the bank policy percentages, you can use either one. That the loan is fully secured if you have not taken all the collateral. If it's a small loan, not only you have to make the statement in there that that you have taken all collateral as the bank would on similarly sized non-SBA guaranteed commercial loans. And we go as far as to say SBA 5010G, page 162. If a business plan is involved, reference the business plan frequently. You've got to say that you've looked at it and it's accessible to you, and then you have to list the pros and cons in the analysis to prove that you've actually read it. and you'd be shocked how many people just stick it in there and never read it. Go on. Credit analysts for small loans. If everybody probably is aware that under the new policies, in an effort to get credit out to the quote-unquote underserved markets, SBA has pretty much done away with underwriting. They've done away with underwriting as far as the submission process is concerned, because they're concerned about how much time and effort goes into generating a credit memo. 95% of the lenders that we represent are small banks being under, say, $250 million. Those banks, for them, $150,000 to $350,000 loan is a reasonably large loan. So the credit memo still needs to be done, even though SBA does not require it, if that is what your bank would do on a similarly sized credit. If you were one of those behemoth banks that credit scores everything under 350 or 500 or whatever it is, that's fine. I'm just saying that if you're used to doing analysis on loans of 350 or less, continue to do the analysis on the loans 350 and less, even though SBA does not require it. Even if you do not require, if you do not do the credit memo, you still have to make a statement in there that the equity and the pro forma debt-to-worth ratios are acceptable to the bank's existing policies and procedures, and you have to state that the business financial statement and the personal financial statements have been reviewed and are consistent with banks' similarly sized non-SBA commercial loans. Okay, go on. The 1919. Okay, we're going backwards again. Okay, again, on the 1920, that's the bank's application. Just make sure that your interest rate, term, and use of proceeds are consistent with your credit memo. ETRAN, as everybody is probably aware, SBA is going to a completely electronic process. If you do not have an ETRAN account, go ahead and sign up and get one. Once you go through the process and sign up, you've got to select your functions that you're going to need. 99% of the time, all you're going to need is lending and servicing. You input your location ID, and the location ID is assigned to you when you filed your 750 agreement. And again, Richard can walk you through the process, but you go to 4 lenders on the SBA website, go to ETRAN, and then look up location ID. And then you just plug in that number, and then it'll take you 2 to 3 days, and SBA will send you back a confirmation that you are registered for ETRAN.
Yeah, they can just check with us, Leo and I. We have a list of those, so saves
okay.
us step in there. So.
All right. Going on. When you do the ETRAN submission, which is when you send in your documents, SBA they say they will not take paper documents. They still will take paper documents, just they hate it. And it will sit on somebody's desk for 2 weeks, I guarantee you, in Sacramento before somebody actually scans it in so somebody can process it. So instead of a 3-week turnaround, you're probably looking at 2 months. So do not submit any paper files to SBA. If you take nothing away from this presentation, don't send paper. If you do an ETRAN submission, it'll take you about 15 minutes. Again, the big keys here, double check the interest rate, term, and use of proceeds with your credit memo and your 1920. Once you have entered the guarantor and owner information, you are finished. Do not start attaching stuff because you're uploading a 10-tab submission file prior to submitting it. For small loans, you're going to have to do the credit score. We do that as soon as we start looking at a loan. You'll have the information that you can go ahead and plug in and make sure it scores. I believe, Ray, the score is 140, correct?
Yeah, that's correct.
It is 140, yes.
Okay, so it's going to have to be a pretty stinking loan not to rank 140. The ones that we find that do not rank are those businesses that have already started and are in the startup stage and are not profitable yet. Those will typically not score. Under those circumstances, and you still want to do the credit, you submit it just like a regular 7A application, but the $350,000 business assets only exemption does not apply when you submit a loan regular 7A that does not credit score. So in other words, you have to take all available collateral. Once everything is complete and the 10-tab submission file is uploaded, you just hit submit button, If any fields are skipped, the system will state that the application is in process. You just need to go back through, and it should identify which fields have not been filled out. You fill them out, and you hit the submit button again, and then you want to see the reply in reviewer stage. Moving on. These are the links that are valuable to you. These are for your forms for the 1919-1920. This is the debt schedule that we use on every loan request, and this is the link for the 10-tab submission template. Okay, the credit memo format. These, again, this is Capital Growth Solutions internal stuff. We basically have set up an Excel spreadsheet that feeds on itself, and this is the information that we put in there. But this is the minimum information SBA is going to want when they get an application. The borrower, the legal name of the borrower, the address, the NAICS code, what the specific industry is, a description, a franchise. Everybody should know about the franchise eligibility. If they don't, that's a whole seminar in itself. The loan amount, processing method, if you're going regular 7A, CLP, or PLP, and then the guarantee percentage. Guarantees are anywhere from 50% for the express product to 90% for anybody in first or second generation exporting. Guaranteed percentages, a lot of people don't know this, but probably 20% of the loans we process through our office have international trade components, which allow them to get a 90% guarantee versus a 75% guarantee. And the process does not take any longer than the regular 7A process. Executive summary. This is, keep in mind the person at SBA is going to be seeing probably 5 or 6 loans that day, and they are not going to have a clue who your borrower is. We like to make it very simple, probably written in like a 5th grader. You know, the old TV show, Are You Smarter Than a 5th Grader? You don't have to be. Write the memo so that a 5th grader could understand it. Tell the story. Start about, you know, why the loan request, how you got involved, what you're trying to accomplish. At the very least, though, you got to hit on what the use of proceeds is going to be, a description of the project, an outline of your project request, the dollars requested, state your term, interest rate, and payment. Again, like I said, you're going to hear that a bunch. And then state what the ejection is going to be and where it's going to be coming from. For your collateral analysis, make sure that you list your collateral, the value of the collateral, what liquidation percentage you're going to be using, and the net liquidation value of that collateral. It's my understanding, this is what we do. If the bank has a valuation method they use, we would typically use that unless the SBA's is more conservative. If the SBA's is more conservative, we would use that, but I don't think I've seen a business, a bank yet that has more liberal terms than the SBA's liquidation evaluations. Go over your business operations and history, do a detailed analysis of the business and an analysis of the business plan if applicable. This is where you would go over, you know, the profitability of the company, you know, what its business cycles are, and why we're going after the, you know, why we're doing the loan request. Management and guarantors. This is something that's critical in our opinion. I'd say in almost every circumstance, those individuals that have a lot of experience in an industry almost always succeed. Those people that are getting in the industry for the very first time seldom succeed. So just that's an important factor as far as our analysis goes. Go on. On the financial analysis, we don't spend a lot of time internally on balance sheets because small business balance sheets can be so funky because of just the way they're structured. They can be highly leveraged because it's an LLC and people take the money out of the business to live on. But you at least need to look at the balance sheet and make sure nothing just jumps out and grabs you, like the current ratio is 100 to 1, something like that, showing that the company's not going to survive because they don't have the current assets to service their current liabilities. Repayment ability is the key to any credit. SBA is a cash flow lender. Net income plus depreciation plus interest expense is the thumbnail, quick and dirty SBA analysis. And if you're looking at debt service of 125 to 1.5, that's going to be your typical SBA loan, which is good. If you're looking at the 1.15 minimum that SBA says that they will live with, you're going to be you're tempting fate, I guess is the best way to put it. Look at historical numbers more so than projected, because projections can pretty much say whatever you want them to say. But if you are going to use projections, analyze the tar out of them and make sure you understand exactly where those numbers are coming from. We shock our interest rates 2% and 4%. Prime is not going to be at 3 1/4 forever, so we assume prime at 5 1/4 and 7 1/4. If it's at break even at 7 1/4 prime, we're satisfied with the analysis. And then you need to also do a global debt service coverage with the different entities that people have now. You're going to have to make sure that all the companies are cash flowing. People have Schedule C income on their personal tax returns, K-1s, which may alert you to the fact that there are other businesses out there that they may be contingently liable for, or they may have cash contributions necessary to shore up other businesses. On the guarantor analysis, make sure that you've done one for each guarantor, which includes an analysis of their personal financial statement. Look at their personal tax returns, and again, look for K-1s and Schedule C and Schedule E items. Those will tell you if there's other businesses out there they may have failed to mention to you. Look at the credit report. SBA will not process loans that have existing credit outstanding liens. They can have poor credit if there's an explanation for that poor credit. But if there's existing liens out there, assuming it's not fraud or something like that, SBA is going to suspend processing that application until those credit reports are cleaned up. And again, just include a personal cash flow analysis, which Ray's going to go into a little bit later. Specific things for SBA loans, you have to state that why you're doing it in an SBA loan, credit elsewhere test. It can be term, it can be the size of the loan, it can be the collateral availability, it can be industry type, it can be location. There's a number of reasons to do SBA loans. One of them is not because it's a bad loan. You have to address the size standards. Again, it's typically, I believe now, it's 500 employees. Just about everybody qualifies for an SBA loan. And in debt refinancing, again, you want to make sure what you're doing is for the benefit of the small business. But again, if the credit's got a balloon on it, almost always it will qualify for SBA financing. In a summary, just make sure that somebody has actually signed the credit memo. Don't just send it in there in a blank format. We usually have the senior lender or the senior credit officer sign off on our credit memos. Okay, Ray, your turn. You awake?
Yeah, I'm awake. I'm sorry. Sometimes my phone goes to sleep on me, but I'm still awake. I was on the edge of my seat the whole time. Gary.
All right, go ahead.
All right. Gary had talked about and alluded to the debt service coverage ratio requirements, and they change quite a bit. So you have to be careful about what we have in here. The 50-10-5G states that the small business applicant must debt service ratio its debt by 1.15 times on a historical and or projected cash flow basis. The key here is 1.15. And then global cash flow analysis must include an assessment of the impact of cash flow to and from any affiliate business. If you'll note, the 50-10-5F stated that the global debt service coverage had to be 1-to-1. The 5G does not state that. It's still highly recommended that you have a debt service coverage ratio of 1-to-1 globally. The other aspect here on the debt service coverage at 1.15 times is to remember that that's on both a historical and on a projected basis. If you have a startup company that is going to take a while to get to the 1.15 debt service coverage, and because they are a manufacturer or we are looking at something right now that's going to take 2 years for them really to get to that point. In conversations with the SBA, you need to be able to show month-to-month projections to show when that business does finally start debt servicing at 1.15 and that you have sufficient working capital to get through to that point. And we'll go over cash flow and adequacy of working capital here in just a bit. Okay, the SBA does not formally dictate the definition of global cash flow, but it says it includes all of these things. It needs to have the income and or loss from any affiliated companies. It needs to have adjustments for any intercompany transactions, personal financial needs of the guarantors, analysis of both cash-based and accrual-based statements where appropriate, and then an explanation of any excluded debt. Debt that's being placed on standby, debt that's being paid off in a short period of time, etc. And any non-recurring expenses would also fall into that category. So in going through that, then what I've done is I put together here a standard debt service coverage ratio analysis where you take the net income of the borrower, you add back the rent, and you would only add back the rent in a situation where you were doing some kind of a rent replacement with regards to an existing renter buying a building, then you would be able to add back that rent. Interest expense, you're going to add that back because you're going to take out the total debt service for not only the subject loan but all of the other debt that the company might have. The depreciation or amortization, you're going to add back. Typically what I do is I add back the officer's salary and we calculate an officer's draw or a new owner's compensation, and that's based on the needs of that individual. Different lenders will have different criteria. They'll have a debt-to-income ratio that they feel they need to meet, things of that nature. Whatever your calculation is, explain it and how you got to your draw requirement. That gives you your cash available to service the debt, your projected debt service in this case it's $200,000. That leaves you the excess cash flow and the debt service coverage ratio at 1.90. So that is your cash available, very easy, cash available divided by your projected debt. So that's your debt service coverage ratio. Now we've put together, and I have seen, and Gary probably has as well in dealing with a lot of different lenders, how they calculate their global debt service coverage ratios and things of that nature. As Gary had mentioned earlier, you want to write something at, and I give the, for benefit of the SBA people who might be on the line, I give you a little more credit. I get you to the 7th grade level. But that's a pretty standard thing for everybody. You don't want to be too complicated in what you do, and I've seen some very complex things that people can't understand, and then they have a series of questions. So I make it simple. I keep it very simple, and the more that I can do in pictures, the better. The people who are looking at it are credit people, and credit people prefer pictures to words. So the personal cash flow of your guarantor, the EBITDA of the operating company, the EBITDA of any affiliates, and that gives you your total existing cash available, cash flow. Then you would go with the personal debt of the guarantor, personal debt or the existing debts of the operating company, existing debt of any of the affiliates, and then the proposed new loan. And very simply then you're going to take your total existing cash flow divided by your total debt, and that will give you your global debt service. So, and that's it. In that ratio, I do not include, like we were talking about just a second ago, I do not include the any kind of a debt-to-income ratio, anything of that nature. All I am doing is calculating specifically the global debt service. If you, as a lender, calculate it a different way, that's fine, but you need to explain it. The SBA, like I say, they see thousands of different versions of what you calculate, and they don't. If you want to slow down the process, make it more complicated, and then don't explain it. So, definitions. The SBA is a little bit more specific in how to calculate your cash flow coverage. The definition of OCF, or operating cash flow, is simply EBITDA. The debt service is equal to the P&I of all business debt included in the subject, including the subject loan. Your debt service coverage ratio simply then is your cash flow, or EBITDA, divided by your debt service. The other calculation, the other adjustment you will need to make is unfunded capital expenditures. The amount, and this is the amount of capital expenditures less any capital expenditures funded by permitted debt, subordinated debt, or other proceeds of any equity issue of the borrower. So that's a mouthful. Bottom line is if you have a company that has significant capital expenditures on an ongoing, recurring basis, you need to make adjustments for those. You cannot just ignore the fact that they have to replace machinery and equipment every 3 years, or that they have hundreds of thousands of dollars in those kinds of expenditures on an annual basis. So even though those are balance sheet transactions, you do need to account for the fact that that cash does leave the business. Okay? Tax returns, business tax returns. When you look at tax returns, you're going to look at several sections. Obviously, on a business tax return, you're going to look at the front page, whether it's your 1120 or your 1065 or your other business financial tax returns. You're going to look at the front page. That's going to give you the bulk of the information that you need. You're also going to look at, in that first page, they're going to have a place for other expenses. Find the correlating statement for those expenses and make any necessary adjustments. I highly recommend, although I do for lack of a better term, a quick and dirty debt service coverage ratio, I always do a detailed income statement analysis so that I can see the changes from a percentage base of certain categories from year to year to help explain ups and downs potentially of your debt service coverage. So in other expenses, you're going to look primarily, one of the two things you're looking for there is amortization, because that's not included in your depreciation figure on the front page. You're going to look for any kind of excessive fees or one-time fees as potential add-backs as non-recurring expense. Some of those things typically you'll see from a year-to-year analysis. You'll see it in legal fees if they started up a new company, or insurance fees, or some of those things that may have had a one-time boost and then no longer do. Okay, and then M1 and M2 adjustments. Keep in mind that you're looking for cash flow. So if you see huge cash adjustments in your M1s and M2s, you're going to want to account for those, whether they be distributions or whether they be, and I just analyzed the deal recently that showed a $25,000 meal expense. Keep in mind that from a tax purpose, that your meal expenses are only 50%. So you have a $25,000 adjustment potentially to need to make within your debt service analysis. For loans, again, I mentioned before that you're going to want to do a detailed income statement so you can see a year-to-year comparison. Where you see huge anomalies from one setting to another, you're going to want to explain those. I wouldn't put a lot of stock in huge differences in categories in your tax returns historically versus your income statement in the interim period, because many of the things that I do or you do as a business owner are not the same as what your accountant is going to do for cases. There you're going to look more categorical at the end of it and try to see if you, at the end of the day, are falling within the same typical percentages as what you would see, is what you've seen historically. And then you're going to look at the K1s, and specifically you're looking at the K1s. What I do primarily is I'm looking at those K1s to see what distributions are potentially taken, but I'm also looking for that percentage of ownership. You would be surprised the number of people who don't know what the percentages of ownership are in their company. Take a look there, because from an eligibility perspective, what Gary talked about earlier, you need to know who the owners are, who the 20% owners are specifically, and keep in mind that the SBA has a 6-month look-back period. So if somebody diminished their percentage of ownership below that was above a 20% is now down below a 20%, and that occurred within the last 6 months, that person may still need to guarantee the loan. Personal tax returns, obviously you're looking at Schedule C income. You're looking at whatever their wage income, if you're considering that and determining how much of a draw they're going to need for the business. That wage income, you know, if it is going to be ongoing, whether it's from the guarantor's spouse, however you're counting it, you're going to want to make sure that that number matches what you're using historically. Schedule C income, obviously, if you're analyzing a sole proprietorship, that's where you're going to find all your information within the Schedule C. If that Schedule C is an affiliate, then you're going to want to consider that in the global cash flow. And then recognizing potential affiliates, you're going to want to look at your Schedule E to determine if your borrower failed to mention any other affiliates on their application package. Again, you want to analyze all affiliates. Okay. Adequacy of working capital. This is a key component to the credit decision and one that's scrutinized in repurchases and audits. The lender must determine and justify the adequacy of working capital in the loan request. If any of you who have had an SBA audit or review, you'll see this is one of the key things they're very critical on, is the depth to which you have done your working capital analysis and the sufficiency of that working capital. Simply stating that the business is a cash business or that the principals have additional cash if needed is not sufficient. You need to determine what the cash cycle is. How much time will pro forma working capital support the business? We talked about that earlier. And how much availability is there in other lines of credit? These questions must be answered and the amount of working capital in the loan supported. All right. Steps to determine adequacy of working capital for a non-cash business. First, you're going to determine the cash expenses of the business. You're going to calculate the cash needs of the business, and you're going to determine what sources will support the cash needs. We talked about that just a second ago, whether it's going to be a line of credit, whether it's their personal income, whatever that case might be. I will tell you right now, as a credit person, if you're a salesperson on the line and you said to me, well, they'll just tap into their 401k. Gary will probably tell you, echo this, the last thing a borrower will do will tap into their 401k because they know it's protected. All right, working capital analysis calculations. In determining cash expenses, you take your net sales, you subtract out your net income, and you subtract out your depreciation and amortization. That gives you your actual cash expenses. You're calculating your cash needs. Well, actually, let's talk about your calculating the cash cycle in days. You're going to take your accounts receivable in days. You're going to add your days in inventory, and you're going to subtract out your accounts payable in days. That's going to give you your cash cycle in days. Now, in calculating your
Ray,
cash,
let me stop you for a second. How do I find out what my accounts receivable days are and my inventory days are and my accounts payable days are? Where do I get that?
You calculate it, Gary. Leave me alone. We're going to get to that, but if we could jump ahead. No, I don't show that calculation out here, Gary. I'm sorry, but I will. If the folks who are running this will send me this, I'll get that calculation out to you. It's a great question, Gary. Let me go back. So in calculating your cash cycle in days and you're calculating your cash needs, your cash expenses divided by 365 times the cash cycle in days. This is the amount of money you're going to need as a business owner before you earn, so to speak, a dime. If your cash cycle is, in the example that we have here coming up next, let's talk about it real quick. The assumptions: net sales of $2 million. You have a net income of $50,000, depreciation and amortization of $75,000. Accounts receivable are at 45 days. Your inventory days are at 35, and your payable days at 30. Okay. in this example, determining your cash expenses, you're going to take net sales of $2 million. You're going to subtract out your net income of $50,000, and you're going to subtract out your depreciation and amortization of $75,000. Leaves you cash expenses of $1,875,000. Cash, calculating cash needs, actually calculating the cycle of days, you have 45 days in accounts receivable. You have 35 days in inventory. You have 30 days in accounts payable, and you have a cash cycle in days of 50 days. So you make the assumption here that if you look at it from this perspective, you're going to need cash within that 50-day period. So your cash needs, you're calculating your cash needs. You're going to need in the $1,875,000 divided by 365. That's your daily cash need times 50, because that's how long it typically takes for you to cycle your cash. You're going to need, in this example, almost $257,000 from the start. Now that does not, and then we're going to go real quick here onto the what you're going to do, and I think I did it in a slide a little bit further ahead. No, I didn't include that slide. With this, what you're going to want to talk about here is where that cash is going to come from. Now, within your first, if a business is part cash, part accrual, there is going to be money coming in. If this is an ongoing business, a continuing business, you're not going to start that same calculation. This is a calculation that's used for a startup or a business acquisition that's not assuming any accounts receivable. Okay? In the other scenarios where you have an ongoing business, you're going to want to calculate the amount of cash that they're getting in within that time period and actually do a statement of cash flows versus a debt service coverage ratio analysis. We use debt service coverage and cash flow interchangeably, but they are two completely different calculations. So you're going to want to do a cash flow analysis specifically if you have a business that has large or long accrual periods. Cash businesses, very simple. Okay, your annual cost of goods sold plus your annual operating expenses plus your owner's salary, or subtracting your owner's salary, adding your non-recurring expenses, and subtracting out depreciation and amortization. These are your annual operating costs. Divide that number by 12, and you'll get your monthly operating costs. And so if you have a business, I typically want somewhere between 30 and 45 days worth of working capital, even for a cash business. And that's working capital after expenses. So if you have a business startup and they have cash expenses that they're going to, outlays of cash that they're going to have during your closing period, potentially if it's a multiple disbursement with leasehold improvements throughout that period, day one, I like to have 30 to 45 days worth of operating costs as working capital left over. You'll have your own preferences. Just explain why you have that. And that's what I have with regards to working capital sufficiency and calculations.
All right. That's great. Thanks very much, Gary and Ray. At this time, we'll kind of open it up for some questions. Does anyone have any questions at all for Gary or Ray?
Ray, this is Gary. Can you send the calculation of the ARAP and some business cycle over to Richard so that he can disseminate it to all the folks that are on the call?
I will absolutely do that. Not a problem.
Yeah, I can handle that. I'll send everyone a copy of the presentation and a recording of the presentation as well. And we also post these on our website. They're up for at least a year, so you'll have an opportunity to go back and review this if you go to our website and some of the other ones that we do. So, are there any questions?
I know we didn't do that good of a job. Do you have everybody muted possibly, Richard, or did we do that good of a job?
they mute themselves, so let me see if I can unmute them, and I'm sure they have the mute off. And any questions at all? They did an excellent job, so we do, again, do appreciate it. Leo, do you have anything to add?
Oh, I might be trying to digest what just Ray says. That's basically what happened. Anyhow, those two resources are available all the time, I guess, and you're seeing the screen where you can see their information. You can either email Gary or Ray at any time, as well as you can email Rick and I.
Appreciate that. Again, if you have any questions or any comments, please feel free to share them with us. Leo and I are always available to help out, and Gary and Ray's contact information is there. They'll be able to help out as well. So.
All right, and I'll also, this is Gary. Anybody that has any feedback, positive or negative, feel free to email myself or Ray. We do a number of these presentations around the country all the time. We're always trying to do better. So any constructive criticism would be greatly appreciated. And thank you all very much for your time.
I would echo that. Thank you all very much for your time. And if you have any questions or concerns, we know we went through it really fast. So don't be afraid to contact us separately or together, and we'll have answers to your questions.
Thanks very much, Gary and Ray. We do appreciate that. That was a lot of information there, and it very well touched on it very well. So we do appreciate that. Thanks very much.
Thank y'all.
All right, everyone, have a happy holiday.
Your conference is ending now. As requested by the host, please hang up.